So let me share my screen as I give the introduction. Can you see my screen? Just confirm for me.
Yes.
Okay. Okay. So as I was saying, so today's topic is the lesson is quite short. Why? Because we're just looking at the foundation for substantive testing. So tomorrow, we're going to look at substantive testing in more detail. So for today, we're just going to have an introduction so that we have an idea of what exactly we're going to get into. So we're going to look at audit evidence, sampling, as well as audit procedures for substantive testing. So remember last time, it's the same thing that we did for test for controls. We just had this introduction. Then we had an understanding of the different procedures which are supposed to be applied when we are carrying out tests for controls. But now this is a bit different. We're going into substantive testing. This is testing of the books, not just testing the controls of the particular entity, but actually checking the books, the ledgers, and all other important aspects in relation to obtaining audit evidence. So the first thing that we're going to look at is audit evidence. So what is audit evidence? So audit evidence is all information gathered by the auditor which allows them to make a conclusion on which the audit opinion is based. So audit evidence is just the information that we gather, each and every information that we gather. When we go into the business, we inquire from management about how they keep their inventory, where they keep the inventory. We observe the inventory. We ask for management about the going concern of the company. If they've got high amounts of debt, we calculate the gearing. All that is audit evidence. So audit evidence is all information gathered by the auditor which allows them to make a conclusion which informs the audit opinion. Then the other aspect is, what is the meaning of sufficient appropriate evidence? So you hear this a lot. No, the auditor needs to obtain sufficient appropriate evidence so that they can be able to express their opinion. But now, what is sufficient appropriate evidence? So it is split into two. So one, there's appropriateness of audit evidence, then there's sufficiency of audit evidence. So appropriateness of audit evidence just means the quality, relevance, as well as reliability of audit evidence, right? What's the quality of our audit evidence, you know? And this evidence that we obtain, how relevant is it to the particular entity as well as to the particular audit that we're carrying out? And how reliable is this particular information that we have obtained? That's what appropriate means. Appropriateness means quality of audit evidence, relevance of audit evidence, as well as reliability of that particular audit evidence. Then sufficiency of audit evidence just means the quantity of audit evidence. How deep are we going to go in regards to obtaining the audit evidence? What's our sample size? So if the business is risky, then means we're going to have uh, an obligation to sample a lot of items so that we can inspect or observe as many aspects of the business as possible so that we can obtain a lot of audit evidence, and that's quantity. So sufficiency is quantity, and appropriateness is quality, relevance, as well as reliability of audit evidence. I don't know if you have any questions so far.
No questions.
Okay, so let's look deep into relevance and reliability of audit evidence. So relevance is affected by logical connections between the purpose of the audit on which the audit opinion is made, right? Sorry. Yeah. So relevance is affected by the logical connection between the purpose of the audit procedures and the assertions. So remember, the assertions, these are statements that the auditor uses in order to obtain sufficient appropriate evidence, right? So for audit evidence to be relevant, right? The auditor needs to make a logical connection, right? There's this, you have to make a logical connection between the purpose. Why are we carrying out the audit, right? So the purpose of the audit, you know, why are we carrying out these particular audit procedures? Then also the assertions, what are we trying to obtain? What are we trying to test? What are we trying to check in a particular business? So when the auditor makes a particular connection of the purpose as well as the assertions that they're supposed to undertake, then it's going to inform the relevance of that particular information. So if the purpose and the assertions that are being used, they reflect that that particular information that we're obtaining is not as important, then we'll say it's not very relevant. Then reliability is affected by a couple of things, right? One of them is the nature and source of the audit evidence. Where is the audit evidence coming from, right? You observe in the next slides or two. Sometimes audit evidence is reliable if it comes from external parties, right? So in the business, they've got an account balance of maybe 3 million in the bank, but that is not very reliable because it can be subjected to inflation. They can just inflate the figure despite it not being true. So now, if we confirm from the bank, that information that's coming from the bank saying, okay, this company has indeed 3 million in their account, that information is more reliable. So this is what it means. The nature and source of audit evidence informs the reliability of that particular audit evidence. Then two, controls over the preparation and maintenance of the financial statements. So if the client has got strong controls, right? If the strong controls in relation to preparation and maintenance of financial statements, they're very, very strong, then it means,
Hello?
yes, can you get me?
Yeah.
Hello?
Hello?
Yes, can you get
I
me?
get you now.
Yes.
Yes.
Yeah. So I was saying, controls over the preparation of financial statements as well as the maintenance informs the reliability of audit evidence, right? So if the client's controls are very strong, for instance, they've got the right personnel, they've got individuals with the right skill, the right knowledge who are carrying out this preparation and maintenance of financial statements. It means the audit evidence we're going to obtain is going to be reliable to some extent, as opposed to a company where the person that's preparing financial statements is an economist, right? Then the chances that that information that we're obtaining won't be sufficiently reliable. I don't know if you have any questions so far.
No questions.
Okay, so what affects reliability of audit evidence? So we're just going to dive deep in reliability. So what affects reliability of audit evidence is one, the source of that audit evidence, as I explained earlier. Then two, the objectivity and independence. Then three, means of obtaining audit evidence. Then four, internal controls. Then five, form of audit evidence. So one, source of audit evidence. So audit evidence from external sources is more reliable than that which is obtained from internal sources, right? This is what I was just from explaining. The company has got 3 million recorded in the bank account, right? But if we confirm from the bank saying that 3 million actually exists, then that information is more reliable than what is recorded in the books. Because in the books, the amount can be inflated, right? Another example, if we have got receivables, right? The client rather has got receivables that are recorded in the statement of financial position. So sometimes management can inflate the receivables so that they make the financial statements look healthy. So now, if we carry out an external confirmation from the data from the customer and they confirm saying, oh yes, that amount that's written in the books is the actual amount that we owe them, then that information is more reliable. Then objectivity and independence. So if the provider of the audit evidence has no vested interest in the outcome of the audit, they may provide reliable information, right? So if management's job is only to work, they don't have any interest about the outcome of the particular audit, they're not worried about that, then it means they can provide us with sufficient and appropriate evidence, which is reliable, right? And if management is also objective, they are honest in how they're dealing, how they are carrying out the business, they don't have any undue influence. It means that the audit evidence we're going to obtain from them is going to be reliable and it won't have any sort of bias because the people are objective as well as independent in the preparation of those financial statements. Then means of obtaining audit evidence. Audit evidence obtained directly by the auditor is more reliable than that which is obtained indirectly, right? For example, direct assistance of the internal audit function. So if the auditor goes into the business, then they obtain this particular audit evidence. It's more reliable than they contract, or rather they seek the assistance of the internal audit function, because the internal audit function, they may not be as objective because they work in the business and their job is to make sure the controls are functioning as appropriate. Then you give them a job to help you monitor as well as maybe just evaluate the controls. They may not be as objective and they might provide audit evidence which is not very reliable. So if the auditor carries out the work themselves, then that information that is obtained is deemed to be more reliable. Then internal controls. If client has strong internal controls, audit evidence is likely to be reliable. This is something we've been covering over and over again, right? So internal controls, the strong internal controls, it means the amount of errors are going to be few. And if the amount of errors are few, then it means that audit evidence that we're obtaining is indeed reliable. Then the form of audit evidence in form of writing or printed is more reliable than oral. So if we receive management representations in form of writing, then that information is more reliable as opposed to the management just telling us via word of mouth. So now, this is just revision. I included this so that we keep exposing our minds to this information because repetition is indeed the mother of learning, right? So, financial statement assertions for statement of financial position. So these assertions, as we already covered, they look at assets, liabilities, and equity. So we're just going to go through again so that we expose our mind to this information over and over again so that it becomes part of us, right? So now, one, existence, right? Existence. Does the asset, liability, or equity exist? Does it exist? So when we're carrying out our audit, when we're testing the existence assertion, we inspect the assets, non-current assets. If they bought inventory, we inspect that particular inventory. Then if it's a liability, we owe a payable, we make an external confirmation. Do we actually owe Dangote this particular amount of money? And that's confirming the existence assertion. Then rights and obligation. Does the client own the rights, the legal rights to the asset, and does it have the liability to offset that particular obligation or liability? Does it have the legal obligation to offset the liability? So those are rights and obligations. Then completeness, have all assets, liabilities, and equity that were supposed to be recorded been recorded, and all disclosures that have been included in the financial statements have been included, right? Have all the assets, all the liabilities and equity, and everything that is supposed to be included in relation to recording those particular transactions that are relating to assets, liabilities, and equity. Have they been recorded as they supposed to be recorded? And the necessary disclosures, have they been disclosed and included in the financial statements. Then if that has been done, then the completeness assertion has been achieved. Then accuracy evaluation and allocation. Have all assets, liabilities, and equity been included in the financial statements at the correct amounts, and any resulting valuation or allocation have been properly recorded? So, assets, an asset when it's bought, it has to be valued. We use a certain mode of valuation. An asset is valued at cost. It includes the purchase cost, you less the discounts or rebates. You include all the tax expenses which are incurred, all the incidental costs that are incurred in order to bring the asset to its working condition, and uh, you also add the present value of all future cash flows that are related to restructure in that particular place where the asset is mounted. Have all those amounts been valued, correctly, right? Have they been allocated to the particular asset or liability correctly as they are supposed to be recorded? That's accuracy evaluation as well as allocation. Then classification. Have assets and liabilities and equity been recorded in the proper accounts? Have the assets been recorded in its for instance, we buy a house, we buy a house. Has that house been recorded as an asset in its appropriate account? Or maybe it has been recorded as a liability. So all those items are what are considered in the classification. So then presentation. Have all assets, liabilities, and equity interest been aggregated and disaggregated and fully described? So this is just revision. I won't really spend too much time on this. I don't know if you have any questions so far.
No questions.
Okay, so again, this is revision. We look at the audit procedures. Now, this time it's in the context of substantive testing. So the audit procedures that we're looking for, well, what we're looking at now are not the context of tests for controls, but this is in the context of substantive testing. So one, inspection of assets, you know. So these are audit procedures. Even when you're telling the examiner, the examiner tells you, provide maybe 3 substantive tests for a particular asset or maybe inventory, right? Then these are the procedures you need to use. You inspect the assets, you inspect the documents and records, observe, inquiry, external confirmation, reconciliation, performance analytical procedures. So inspection of assets, physical inspection of tangible non-current assets to obtain evidence of their existence. So we're fulfilling the existence assertion. So we inspect the asset. We carry out a physical inspection of tangible non-current assets. Then inspection of documents and records. The auditor examines the documents or records of the entity and also from external sources in all forms, paper and electronic. So inspection of documents and records. We check the ledgers, both paper as well as electronic. We check the ledgers, we check the invoices, we check the goods received notes, we check the goods dispatch notes, all those documents that are relating to goods and services coming in and out of the business. We inspect. Observation. We watch the client staff perform the specific control, right? We go into the business, we observe the client carrying out their respective duties, then we obtain the evidence rather. So inquiry, asking clients, management, and employees how the transactions are carried out and treated and how the controls work. So we inquire for management. We just have a conversation with management. How does this happen? Which areas of the business is fraud likely to happen? Then we are inquiring. We ask the employee, okay, employee, what are your qualifications as an accountant? Then the employee tells us, then we're also making an inquiry. Then external confirmation, obtaining information from third parties that confirms the existence or occurrence of account balances or transaction or events. So external confirmation, we call the bank. The bank, is this balance that we have here in the book correct and accurate? Is it the amount that you have there in your bank? Then the bank confirms, and that's what we call external confirmation. Then reconciliation. the auditor performs computations that lead to balances in the financial statements. For instance, payables, each, like, in the books, each customer has got their own account, then there are several transactions that happen. There's, return goods returns, then, there's also like damaged goods and other stuff. So now the auditor needs to reperform the control accounts. Just how do we arrive at the receivables balance in the statement of financial position? Then, if the auditor carries out that performance, it's called reconciliation, right? Then reperformance, the auditor performing procedures that were performed by the employee of the company. For example, bank reconciliation. So bank reconciliation is performed on a monthly basis. Then the auditor, gets 1 month or 2 months bank reconciliation statements. We get the bank statement from the bank, then we perform that particular bank reconciliation. Then probably we might be able to detect and observe some errors or misstatements. Analytical procedures, as I already outlined, analytical procedures is just comparing. A simple explanation of analytical procedures is comparing uh, different transactions and items. Any questions so far?
No questions.
Okay. Then we have got substantive procedures. So substantive testing is performed when the auditor believes that the client has ineffective and inefficient internal controls, or the tests for controls have provided evidence that the internal controls are ineffective and inefficient. So as I have been talking about it, so substantive testing is carried out when the client or the auditor believes that the client has got, pathetic or ineffective and inefficient controls. So if they at the risk assessment stage, the auditor believes that the client's controls are not working properly, then we're going to carry out a substantive procedure. It's going to carry out substantive testing. Then if we test the controls, at face value, we believe saying the controls are working, then we carry out a test for those controls. And in the process of testing the controls, we discover that those controls are very pathetic, they're inefficient, they're ineffective. Then we can also carry out substantive testing. So substantive testing includes substantive analytical procedures, and substantive analytical procedures, again, is just comparing whether statistically or non-statistically. Substantive analytical procedures and detailed tests of classes of transactions and account balances and disclosures. So you carry out a detailed test, you go in the books, you check the ledgers, you reperform the controls, you know, you just go deep into the books so that you can obtain sufficient appropriate evidence. Then there's also what we call directional testing. So when we're carrying out substantive testing, there's what we call directional testing. So what's directional testing? So these are procedures carried out according to the direction of the transaction. So these are procedures that are carried out according to the direction of the transaction. And there are two. There's tests to discover errors, then tests to discover omissions. So tests to discover errors, the auditor begins with the accounting records and then compares the data with the relevant document or evidence. So now, in simple terms, this is where we're trying to discover an error, right? Maybe want to discover an error for an invoice, for a specific invoice, right? We received a supplier invoice from maybe Zambezi, Portland, right? So we begin with the books. We check the amount that's in the books, that's in the payables ledger with respect to the account of the supplier, the personal account of the supplier. We check that particular amount that's in the book, right? That's in the payables ledger, the personal account. Then now we get the invoice that Zambezi Portland sent to us. Then we compare. Then we're testing for an error. So if we compare, we first begin with the books, we check the amount that's in the book, then we look for the invoice, and then we compare. Then we can be able to check if there is an error, right? Then the opposite happens when we're testing to discover the omission. The auditor begins outside the accounting records and follows the transaction through the books. So we begin with the invoice, the supply invoice from Zambezi Portland. Then we follow that invoice through the accounts, right? Then we can be able to detect an omission. So we get that particular invoice, then we check how did it move from the supply invoice to the payables ledger. So if we follow that process, then we'll be able to detect an omission. And this is what we call directional testing. Any question?
No questions.
Okay. Or contributions?
No contributions.
Okay. So now let's look at audit sampling. So what is audit sampling? So audit sampling is when the auditor examines less than 100% of relevant audit data in a population where all items have an equal opportunity of being selected. So again, I'll reiterate, the auditor doesn't manage to inspect the whole financial statement. All the items of the financial statements are not inspected because it is very, very complex. Maybe with the coming in of computer assisted auditing techniques, a large sample of information is tested. But in actual sense, auditors carry out audit sampling. They just get a portion of the information in the financial statements, then they use, they apply their procedures and tests on that particular sample. Then they will conclude saying if this sample is reflecting this particular transaction and all that, then it means the rest of the information has got an equally similar effect. So that's audit sampling. So audit sampling is when the auditor examines less than 100% of the relevant audit data in the population where all items have an equal opportunity of being selected. Then there are two types of audit sampling. There's statistical sampling, then there's non-statistical sampling. Statistical sampling involves, so items are selected at random using probability theory to evaluate the sample results and measurements of sampling risk. So this statistical sampling just involves mathematics and statistics so that we obtain the sample that we're looking for. The non-statistical information is more subjective. You just use a professional judgment and then you are able to obtain that particular sample size that you are looking for. So now, ways of testing, or rather ways to select items for testing. So this is just for knowledge's sake. I don't think they examine this, but the auditor can select high value or key items, so items which look suspicious. So if they are about to carry out the substantive testing, then there's some items which look suspicious. Then there's some invoices, maybe some invoices which are looking suspicious according to the auditor's view. Maybe the amounts there, they're too large, or maybe the frequency of the invoices is too quick. So maybe initially the company has got a policy of 1 month credit, then you discover that the invoices are coming in, or rather the payments are coming in quick. Instead of 1 month credit, it's taking 2 weeks or maybe 1 week for that invoice to be settled. Then there can be that skepticism by the auditor saying, maybe there's something that can be wrong. Then we're going to make sure we sample this amount of receivables or payables as appropriate. Then selection of items over a certain amount. So if you say if invoices are above say 1,000, so all invoices above 1,000, those are the ones that we're going to select, and that's one of the ways of selecting items for sampling, but this is just for knowledge's sake. Right. Then how do we design a sample? So there's a few things that we need to know. We need to first be aware of sampling risk. What is sampling risk? So sampling risk is risk that the auditor's conclusion based on a certain sample size may be different from the one arrived at based on the full population of the data. So if the auditor carries out a sample testing, they test a particular sample that they select, then they make a decision based on that sample, right? If the decision they make, is wrong compared to what decision can be made if they inspect or they test the whole data, then that's sampling risk. So this is risk at the auditor's conclusion based on a certain sample size may be different from the one arrived at based off the full population of the data. So if, as I already explained, the decision is made based off a sample size, and the risk that it may be different from the one being arrived at or the one that can be arrived at by inspecting or making a decision based off a whole population of data, that's sampling risk. The non-sampling risk is risk of arriving at a wrong conclusion for other reasons other than relating to the sample size. So you arrive at a wrong decision without taking into consideration the sample size. So maybe your selection of the sample size is okay, you've done everything right, but you still arrive at the wrong decision due to one reason or another, which is far away from the selection of the sample. Then sampling unit consists of all individual items constituting a population. So all individuals in the population is what we call a sampling unit. Right? Then stratification is a process of dividing a population into subpopulations where sampling units have similar characteristics. So if you are sampling, then you discover that these particular items have got similar characteristics, then you bundle them together, you aggregate them, then that's what's called stratification. Stratification. So this is a process of dividing a population into a subpopulation where sampling units have similar characteristics. I don't know if you have any questions so far.
No questions.
Okay, so now, what methods are used for selecting samples? So one, there's random selection, there's systematic selection, then there's haphazard selection, then there's block selection. So random selection, all items in the population have equal opportunities of being selected. So let's say, for example, this sample has got 20 items, right? So if all those 20 items have got an equal opportunity of being selected, you just select at random. You feel like, okay, maybe let me select invoice number 10, let me select invoice number 3, let me select invoice number 3 without any sort of structure or form in which you're going to select those items. You just select at random, however you feel in that moment. You just pick out different sample units. That's random selection. So all items in the population have an equal opportunity of being selected. You just select from random, however you want it to be, right? However you feel. Then systematic selection is a structure or a structural approach to selection. So the approach is a bit more structured. For instance, you've got 20 invoices, right, that you need to select from. Then you say, for every fifth invoice, that's the one I'm going to be picking up. So you begin from invoice number 5. Invoice number 5, you extract it, right? Then you count 5 more, right? Invoice number 10, that's the one you extract. Then after 5 again, invoice number 15, that's the one you sample. Then after 5 again, that's 20. Invoice 20 is the one you pick. So that's a more structured, and it's called a systematic selection, right? Then haphazard selection. So haphazard selection is just selecting items without looking. So you just close. So you've got a series of invoices. You've got 20 invoices, and you're supposed to pick 5. You just close your eyes, then you start picking. You pick one, you put it aside. You close your eyes again. You pick one invoice, you put it aside. Then you close your eyes again. You pick one, you put it aside until you pick the 5th item. Then you've sampled haphazardly without looking at the information, like you just, close your eyes, or maybe you cover your eyes while you are sampling that particular population. Then block selection, selecting a group of items in a population as a basis of audit procedure. So for instance, we've got 20 invoices. I'll go back to 20 invoices, right? So now, if we say, okay, the first five, or maybe we say the middle five, 10 to 15, those invoices have got similar characteristics. You just get those five. Then you agree that they block. You just get that block. So invoice 10 to 15, those five invoices, you sample them, right? And that's what we call block selection. So you just select a group of items in a population as a basis of audit procedures. With that said, our lesson has come to an end. I don't know if you have any questions, clarifications, or additions, subtractions, or anything in between.
No addition, Mr. Patrick.
Okay. All right.
Okay.
Or anything to say as I'm trying to stop the recording.
Oh, okay, okay, okay. I don't know what I can say, but the same things we've been learning.
Mm-hmm.
So yesterday,
Mm-hmm.
the auditor came, Mr. Patrick.
Mm-hmm.